Hello everyone, this is ACCA Amit Kumar and we'll discuss in Ind AS 12 income taxes. So there is a change in the computation of deferred tax, like we were using P&L approach, now we'll be moving on to deferred taxes balance sheet approach. So we'll have a look at the deferred taxes balance sheet approach through this discussion. Now in the balance sheet approach, we will directly compare the carrying amount of an asset with the tax base of an asset. To be able to understand it, let's understand the reason for deferred taxes. Now, when we account for income taxes, there is a difference between the accounting principles, and when we calculate the tax computation, it may be different from the tax expense calculated by us according to accounting principles. The reason being there are disallowable expenses which are not allowed today, which will never be allowed in future. There may be incomes which are not taxed today will be taxed in future. So these may result into permanent differences. Permanent differences are accounted for immediately. And do not result in future tax consequences. But if there are temporary differences, deferred tax assets or deferred tax liabilities. Now we are moving away from timing and permanent. So two types of temporary differences: taxable temporary difference give rise to deferred tax liabilities. Deductible temporary differences give rise to deferred tax assets. In other words, DTL and DTA. Suppose an entity has bought a machine for 100,000 and its useful life is 5 years. Depreciation charge according to accounting book says 20,000 per year. Tax authorities allow accelerated depreciation over a period of 2 years. So the year 1 accounting, if suppose profit before depreciation is 200,000, depreciation charge for the year is 20,000, profit after depreciation is equal to 200,000 minus 20,000, that is 180,000. This is as per accounting books. The same thing as per textbook says 50,000, and if the tax rate is 30%, of 1,80,000 and 30% of 1,50,000 is 45,000. So profit after tax equals to 1,80,000 minus 54,000. So if we look at the difference, the tax expense calculated by us is 54,000, tax authorities is 45,000. So in case of accounting for income taxes, we need to remember that we will behave as an accountant, we'll follow the accounting principles. If there is any difference in tax computation with what they are demanding, we know they'll be demanding it in future. Reduction today, they are saying that we'll allow that reduction in future. These result will temporary differences. We'll account for the differences therefore tax. If there is a permanent difference, if there are no future tax consequences, it results in no DTA, no detail. But if there is, we will be liable to pay more taxes in future, we need to be prepared for it. If we'll be allowed reduction in future, we'll get a credit for it in future. So we'll get a DTA. So this difference, so we'll recognize a tax expense of but tax payable is not the entire amount of 54,000, it is only 45,000 because that is the current tax. So we record a deferred tax liability credit difference of 9,000. So the tax expense in the income statement is a combination of both current tax and deferred tax expense. Current tax 45,000, deferred tax 9,000. In the balance sheet, there is a deferred tax liability balance of 9,000. In the second year, the accounting is same. I'm assuming the profit to be similar over and accounting for taxes. Second year again, the accounting is same. The balance sheet is now worth 9,000 plus 9,000 of year 2. Total 18,000 is the deferred tax liability balance in year 2. In year 3, the depreciation charged by accounting books is nil because we've already depreciated it over a period of 2 years, resulting in a higher demand. So suddenly the tax payable is 60,000, an expense of 54,000. So there is a difference of 6,000 this year. We'll be reversing the liability. We'll be reversing the liability, debit 6,000. The tax expense is 54,000, but current tax payable is 60,000, and deferred tax is reversing the liability, credit of 6,000. This is the impact in year 3, and the deferred tax liability balance reduces by 6,000, that is 18,000 minus 6,000. Everything remaining constant, the deferred tax liability balance reduces to 6,000. And in year 5, the deferred tax liability balance reduces to nil balance. So the first 2 years we charged escalated depreciation, but we knew that we'll be liable to pay more tax in future, so we created deferred tax liability of 9,000 in year 1, deferred tax liability of 9,000 in year 2, taking the balance to 18,000. In the third year, DTA is not created. Remember, it results into reversal of DTA or DTL. So in the third year, there was a reversal of deferred tax liability. The liability balance of 18,000 reduced to 12, fourth year reduced to 6, fifth year reduced to nil balance. This is the P&L approach. The same thing we could have done using a balance sheet approach. The same accounting we could have done using the balance sheet approach. That's what we need to learn, balance sheet approach. To calculate deferred taxes. We have accounting books. Textbooks. One, when we bought the machine, it costed us 1 lakh. Tax authorities also believe that we have bought a machine which is going to give us economic benefits of 1 lakh. If the tax rate is 30% to tax authorities as well in the form of taxes. So on day 1, we can see the balance is this. Here it was depreciated by 20,000. This was depreciated by 50,000, so net book value is 50,000. Year 2, end of year 2. That the carrying amount of an asset is compared with the tax base of an asset. If carrying amount of an asset is higher than tax base of an asset, it gives rise to, if an asset is lower than tax base of an asset, it gives rise to DTA. In case of a liability, it is opposite. If carrying amount of an asset is lower than tax base of an asset, gives rise to DTA. In case of a liability, it is opposite of what happens with asset. If carrying amount of a liability is higher than tax base of liability, it will give rise to DTA, opposite of what happened with asset. In case of a carrying amount of a liability is lower than tax base of liability, it will give rise to DTL, opposite of what happened with asset. So if we know one line, can we formulate the other four? Case of asset, liability, if carrying amount base. If carrying amount is higher than tax base, if carrying amount is if we're dealing with an asset, if carrying amount of an asset is higher than tax base of an asset, it gives rise to DTL. If carrying amount of an asset is lower than tax base of an asset, it gives rise to DTA. In case of a liability, it is opposite. In case of a liability, it is opposite. If carrying amount of a liability is higher than tax base of liability, it gives rise to DTA. And if carrying amount of a liability is lower than tax base of liability, it gives rise to DTL. With asset, it is opposite with liability. So remember, one line we can formulate the other four. This is the balance sheet approach. Now in the same example, if we apply the balance sheet approach for an asset wherein the depreciation was over a period of 2 years allowed by tax authorities, with the same example, we use the balance sheet approach. Tax authorities allowed over a period of 8 years. The balance sheet approach we need to calculate it over a period of 8 years now. The textbook says the first year depreciation is net book value after depreciation is 87,500. $75,000. Then it is $62,500, $50,000, $37,500, $25,000. 12,500. Day 1 it was 100,000, same. So in case of an asset, if carrying amount of an asset is higher than tax base of an asset, it gives rise to DTL. If carrying amount of an asset is higher than tax base of an asset, it gives rise to DTL. In the previous example, carrying amount of an asset was higher than tax base of an asset, give rise to DTL. What if carrying amount of an asset is lower than tax base of an asset? If carrying amount of an asset is lower than tax base of an asset, it gives rise to DTA. Carrying amount of an asset is 80,000. It is lower than the tax base of an asset, which is 87,500. The difference is 7,500. If the tax rate is 30%, 2250 is DTA, therefore tax asset. Second year, 60,000 is carrying amount of an asset is lower than tax base of an asset, giving rise to DTA. The DTA built, and from 5 year onwards, it started reversing. The first year DTA is 2250, second year doubled 4500, 6150, 9000, 11,250. Then it started reversing at the rate of 2250, reversed over the next 3 years, built up over a period of 5 years, reversed in the next 3 years as this asset was being consumed. So we charge depreciation over a period of 5 years, but tax authorities allowed depreciation. So this was a deductible temporary difference, not allowed deduction today, but will be allowed deduction in future. So we were not allowed full deduction. You were allowed a deduction of only 12,500. We expected a deduction of 20,000. So there was a difference of 7,500. Not allowing deduction of 7,500 resulted in creation of a deferred tax asset of 2250, resulted in total DTA reaching 4,500. And then suddenly started allowing deduction of 7,500, resulting in a reversal of DTA. So this is how we deal with balance sheet approach in case of an asset. In case of a liability, if carrying amount of a liability is higher than tax base of liability, gives rise to DTA. If carrying amount of a liability is lower than tax base of liability, it gives rise to DTL. In case of a liability, the definition of tax base of liability is slightly different. The definition of tax base of a liability. It is carrying amount less any amount available for deduction in future. Suppose there is a loan payable of 50,000. When we repay the loan, will we be allowed deduction in P&L? When we repay the loan, will we be allowed deduction in P&L? Tax base of liability will be carrying amount less any amount available for deduction in future, nil, is equal to amount is 50,000, tax base liability 50, future tax consequences. So no DTA or DTL. But if it was interest payable of 15,000, if it was interest payable of say 15,000, when we charge this was expensed to P&L in accounting books on accrual basis. This is a deductible temporary difference. It was said that interest expense will be allowed as a deduction when payment is made on cash basis. So which means that when interest is paid, interest is actually paid, deductible temporary difference not allowed deduction today will be allowed deduction in future. So as I said, tax base of liability is slightly different. It is carrying amount less any amount available for deduction in future. This we need to be careful of. Now in case of deferred revenue, the entity receives an advance for providing goods or services. The amount received is taxed on cash basis but not actually earned as per accounting principles. So we record a cash account, debit say 60,000 received, credit deferred revenue 60,000. When we actually earn it, credit revenue 60,000. So the question arises, will the entity be taxed when they So what is the expectation? And this is presented as part of the liability. This is kind of a liability since you have not earned it. This is presented as part of liability. So in this case, tax base of a liability will be carrying amount less any amount that will not be taxed in future. Carrying amount less any amount that will not be taxed in future. Equal to 60,000 less any amount that will not be taxed in future means 60,000 means this tax base of this liability is nil. Carrying amount of this liability in the books is equal to 60,000 deferred revenue. So when we compare, when carrying amount of a liability is higher than tax base of a liability, it will give rise to deferred tax assets, that is DTA. If the rate of tax is 30%, DTA created is 18,000. This is how we deal with the balance sheet approach under Ind AS 12, accounting for income taxes. In case of business combinations, adjustments are also subject to temporary and we are required to calculate deferred taxes on the date of acquisition and after post acquisition adjustments calculate deferred taxes on the balances as fair value adjustments in the group financial statements. So in summary, we need to remember that one principle which is proven through these examples, that in case of tax base of an asset, it is the carrying amount according to tax authorities, according to their allowable expenses. In case of liabilities, all the liabilities may not be allowed as a reduction on settlement. Some of them will be allowed as a reduction, some of them will not. So the liabilities which are not allowed as a reduction do not give rise to any temporary differences. In case of assets, we recover it through use. So they may be allowed as a deduction in the form of depreciation amortization, resulting in a temporary difference. So if there is a temporary difference, it will give rise to DT or DTL. So in case of asset, the tax base of an asset is carrying amount as per tax authorities. In case tax base of liability is carrying amount less any amount that will be available for deduction in future. Because in case of liabilities, mostly it is through settlement. So whether will be allowed deduction or not will depend on future. So once we know the tax base of an asset and tax base of liability, we need to apply this principle. If you remember this chart, the job is done. This chart is the crux of Ind AS 12 income taxes. If carrying amount of an asset is higher than tax base of an asset, it will give rise to deferred tax liability. Lower than tax base of liability, it will give rise to deferred tax asset, opposite of what happened when we compared the carrying amount which is higher than tax base. So if you know one principle, it will be exactly opposite of what happened with asset. If carrying amount of an asset is higher than tax base of an asset, it gave rise to DTL. In case of liability is higher than tax base of liability, it will give rise to DTA. In case of liability, if carrying amount of a liability is lower than tax base of liability, you can remember by simply remembering one line, and you know very clearly that we believe we are going to earn more in future. If we believe we are going to earn more in future, we will be liable to pay more taxes in future. We will not ignore this fact. We create a DTL. If you remember one principle, you can formulate the other three, but you can also formulate it through a chart. Asset, carrying amount is higher than tax base or carrying amount lower than tax base. In case of an asset, if carrying amount is higher than tax base, DTL. For lower, write the opposite. For a liability, write the opposite of the asset. For carrying amount higher than tax base of liability, what is DTA? For lower, it will be opposite of what happened with liability. So if you know one, you can formulate the other four. This is how we deal with the balance sheet approach under accounting for income taxes. So hope you have understood, and it will not be a complex topic anymore for you, and you can easily understand accounting for income taxes and will be able to account for taxable temporary differences. Taxable temporary differences give rise to deferred tax liabilities. Because we are not taxed today, we will be taxed in future. You will be easily able to account for deductible temporary differences. Not allowed deduction today, will be allowed deduction in future. If you are not allowed deduction today, will be allowed deduction in future. You should be prepared for it. And in this preparation, you create a deferred tax asset. The only thing you need to remember is that if there are any losses or there are unused tax credits, we'll create DTA. We believe be profitable in future. We'll carry forward losses, or if there are unused tax credits, we'll create DTA to the extent we believe will be profitable in future. This is how we'll deal with the balance sheet approach under Ind AS 12 income taxes. So I would request you to subscribe to the courses on Unacademy and use the code ACCA Amit to get instant discount on and do not forget to follow me the code ACCA Amit. So you can have with the name ACCA Amit Kumar, and I've been training on IFRS and Ind AS since 10 years now, and I began my career into IFRS training in 2009, and I have trained thousands of chartered accountants in the last 10 years. And I'm also an author of a book on Ind AS known as Ind AS Concepts in 1 Day.